Hello everyone, this is Carbonomics. I've been following the carbon credit space and carbon streaming for the past year or so. While I had previously held off from buying the company, I've kind of been exploring the question, is the company I buy at these prices? Looking at the chart, we can see that the stock has fallen nearly, 85% year to date. The company's market cap is nearly trading for its cash, as the company has $102 million, and the company currently trades a market cap of $113 million at the time of me recording this video. I'm going to discuss some of the issues the company faces, and if the company deserves the harsh sell-off they've had over the past year. But first, let's talk about what carbon streaming does. Carbon streaming has been creating royalty and streaming deals in the carbon credit space. Now, what does this mean? They essentially provide upfront capital and investment into another company that's working on projects that remove or abate carbon dioxide from entering the atmosphere. And in return, carbon streaming either receives a percentage of the revenues or a percentage of the carbon offsets that a project produces. A company with a royalty or streaming business model still participates in the upside of a volatile commodity like carbon credits, while avoiding much of the risk because they do not have to maintain or dedicate capex to a project after their initial investment. Royalty companies also tend to have a better diversification of revenue sources, as they can invest in a variety of projects. For these reasons and others, royalty companies tend to have far better margins than a traditional commodity business. For example, Franco-Nevada, the largest royalty company in the gold space, only has around 35 employees. The company has a market cap of $25 billion. So you can start to see why this business model is so advantageous. But with that out of the way, let's talk a bit about the management team. And this is where one of my potential contentions with the company lies. The board consists of a variety of previous experience in the royalty and streaming space. And although not necessarily in the carbon credit space, the company did bring in experts, that understand the carbon credit specifically. So that's all well and good. But the problem is with several members of the management team that previously worked at Cobalt 27, which includes the CEO, Justin Cochran. Cobalt 27 was sold in 2019 for around 500 million Canadian to Paula Investments, one of the company's largest shareholders. This angered many of the shareholders at the time, rightly so, in my opinion, to some degree. And that was because cobalt was set to see prices rise higher over the coming years, due to the electrification trend. And Cobalt 27 had one of the largest cobalt deposits in the world, along with cobalt and nickel royalty streams. And if we look at the price of cobalt, it has gone up quite a bit since that deal was finalized in 2019. Now, management argued that this was a good deal considering the cobalt market was starting to turn lower at the time. And albeit that was true, that ended relatively briefly. And the deal was for a buyout in cash. And then investors in Cobalt 27 actually got shares in the new spin-out company of the nickel assets, Nickel 28. Now, the problem with the deal really was its awful timing. The stock had dropped 60 to 70% since 2018. It seemed like there was no real point in raising all this money and buying these assets for cobalt and then selling them all right as the commodities were set to boom. Shareholders really got screwed in a way since they bought in for cobalt, and now they're really getting nickel after many of them were probably already down in their positions at the time. But the shadiest part of the deal overall was the chief executive and chairman of Cobalt 27, Anthony Maluski's connections to Paula Investments, which was the company that ended up buying out Cobalt 27. Anthony previously worked for the company, and if the deal was terminated, Paula was set to receive a termination fee of around $15 to $17 million, which is very interesting. This isn't even mentioning the fact that management was set to receive some large payouts for completing the deal. Maluski was set to get $7 million, although some of these articles did mention that they ended up lowering the payouts at the time, but the company didn't provide much details on that. So this was a weird deal at best. They ended up selling out of cobalt at the wrong time. Management was paid well, and shareholders were left with a new company that they might not have even wanted to invest in. Now, Justin Cochran, the CEO of Carbon Streaming, was the president and COO of Cobalt 27 at the time. And now Anthony Maluski is not affiliated with Carbon Streaming. Now, if we were talking about Justin being in Anthony's position, then and helping out his former employer and having these somewhat questionable connections, then I wouldn't really trust Justin. But as far as I know, Justin just didn't end up timing this properly as far as Cobalt was concerned. Um, so I'm really debating whether or not to give him and some of the other previous Cobalt 27 management the benefit of the doubt on this deal. Either way, this was definitely not a great deal for shareholders. And the only redeeming factor was really that Nickel 28, the spinout company, was performing relatively well since then, going from around 40 cents at listing to as high as $1.65 per share in April. So I'm kind of questioning management. It really makes me wonder, what's stopping them from bailing out on carbon streaming, as well as when things are not going well, especially as they are right now. What's stopping the anything from being different, really? But moving on from that, let's get into the projects carbon streaming has funded. They have certainly been looking to diversify across, geographical regions and credit types a bit more. But many of the projects right now don't necessarily provide very many credits. Um, you can see that they provided capital projects in North America. There's one in Brazil, various cook stove or water purification projects in Africa, and the crown jewel of their portfolio really is in Indonesia. It's a good start overall, but the problem carbon streaming is facing right now is that the vast majority of their credits are coming from Red Plus or Red Forestation projects. This really leaves them with most of their revenue coming from just one credit type. And the vast majority of the credits they're set to receive this year, 2022, are from their project in Indonesia, Rimba Raya. Now, Rimba Raya was going to generate around 7 million red credits this year, but as far as I'm aware, the project is currently paused on issuing new credits. And it's really unclear how many credits carbon streaming is going to receive this year, or if Rimba Raya is started up again. The Indonesian government has placed a pause on new offset issuances until they have defined a clear carbon market policy. And like I said, I'm assuming the project is still paused because there's been no news release on this from carbon streaming themselves. And I haven't seen any news of the Indonesian government. So this is certainly creating a lot of uncertainty around the company right now. With that said, the company's trading very cheaply at the moment. As mentioned earlier in the video, the company is trading at the point where their entire market cap just represents the cash levels. So the market is essentially valuing all of carbon streaming assets as zero. While Rimba Raya is paused at the moment, I really doubt the Indonesian government's going to create a situation where the project is no longer operating, although that is always a risk with any of these projects. As part of the agreement with Rimba Raya, there's already 1 million credits being sold for $8.50 apiece. And if Rimba Raya gives carbon streaming another 5 million credits for 6 million in total, at the current price of $13.50 per red credit, that's around 76 million in revenue, of which carbon streaming gets 15 to 25% of that. So carbon streaming would end up getting around 11.4 million to 19 million in revenue off of this deal. With high gross margins and royalty businesses and higher IRRs in the carbon credit space in comparison to, for example, gold royalties, much of that revenue is going to flow to the company's bottom line. So the company could actually reach profitability relatively quickly. And carbon streaming reported a loss of $5 million last quarter, so you can kind of see where the numbers begin to line up there. So on a price to NAV basis, carbon streaming is trading around a 70% discount to its net asset value. And like I've been saying several times already, you're essentially buying the company for cash. And at the same time, the company has no debt, so there's practically zero risk of bankruptcy here. And the severe discount the market's placing on the company is certainly the strongest argument for buying the company at the moment. But there is another gripe that I have with the company, and it is its share structure and the warrant situation. Um, so Merrick Katusa was one of the largest investors in the company, and he's really known for the concept he coins as the Katusa free ride. Um, so Merrick conducts large financings with the company in a private placement, right? And he and his subscribers will essentially always try to get full warrants, which are similar to options in a way, which they have a set price that can be exercised at. Now, in the case of full warrants, one warrant can be converted into one share. Uh, and this does provide the company with liquidity since it is like you are buying a share from the company. Um, but the Katusa free ride is when Marin sells the stock of the company but keeps the warrant, which in this case expires in 5 years, according to the deal they've done with carbon streaming. So this essentially leaves him with little risk if the stock goes down, and if it goes up, then he can exercise his warrant, and now he has shares, at a significantly lower buy-in price. And given the way the company's performed over the last year or so, we can assume that many of his subscribers have ended up selling their shares in the company, although I'm not 100% sure about that. Now, this is not to say that I'm going after American Tusa by pointing this out. But I am pointing out that his interests are with his subscribers and to his newsletter and no one else. So, this can often leave retail investors stranded in the stocks that he's participating in. Now, what worries me about taking position in carbon streaming is, as you can see here, 40% of the fully diluted share count is in warrants. Meaning if all the warrants are exercised, the share count of the company is nearly going to double. Now, people have come to me with a fair counterpoint to this, which is that this provides more liquidity to the company to do more deals. Which is fair, but it's certainly a concern for existing shareholders and could definitely act as another reason why investors might choose to place their money elsewhere. And another thing I'm not a big fan of is that the insider ownership is not very high at 2%. But overall, for the pros and cons here, for the pros, we have that the company is positioned to benefit over the long term from the ESG trend, which has gone back a bit over the last year, but it's definitely going to reemerge again, in my opinion. The company could be potentially profitable within the next year or two, if Rimba is fine. They are also pursuing an uplisting to the NASDAQ as well, which will provide more accessibility for institutions. It's trading cheaply on a price to NAV basis. Now, for the cons, keep in mind that confusing deal that management previously in Cobalt 27 did, which makes me question their judgment a bit. Rimba Rai is currently not generating credits, and restarting kind of relies on the Indonesian government coming up with new regulations for the carbon market quickly. And I'm not a fan of relying on any government, so that's not a pro. The warrant situation could potentially hold the stock back a bit. That's definitely an overhang. Low insider ownership, and the short-term macroeconomic environment is looking pretty bleak. But the stock is trading at a great price at the moment. And at the same time, the company certainly has its fair share of issues holding it back. If I were to buy into carbon streaming, I'd really like to see the energy crisis turning around for the better before I did. Until then, I don't necessarily see a reason why the stock will not continue to fall at this point. But keep in mind this is not financial advice, and the stock does provide reasonable value with no risk of bankruptcy at the time. So I'll hold off for now. I might take a position at a later time. But that's really it for the video. I do hope that you learned more about the company. And if you did enjoy the video, please remember to like, comment, and subscribe. I really appreciate it. Thanks for watching, guys.